Thank you for the opportunity to talk about an extremely sensitive topic that has been the subject of much debate over the last 2 years. In fact, it was just 2 months ago that the Minister of Trade and Industry and Competition, Mr. Ibrahim Patel, on the 18th of May, released an explanatory memorandum and practice note on broad-based ownership structures, including employee ownership schemes, saying that indeed these structures align with government policy to promote broad-based ownership. And he acknowledged that significant differences of opinion had existed between what the government, the DTIC had intended versus the regulators, the BE Commission, regarding the legitimacy of collective ownership schemes. And funnily enough, almost exactly 2 years earlier, in May 2019, the BE Commissioner had issued a statement saying that the vast majority of broad-based ownership schemes and employee schemes were in fact not ownership. Now, noting that evergreen schemes in which employees participate as beneficiaries and never receive a vested shareholding in the company was actually fronting schemes from the Commissioner's perspective. So while this explanatory memorandum that the DTIC puts this matter to bed and makes it clear that evergreen schemes which provide perpetual benefit to workers and similar sort of non-traditional forms of collective ownership actually do satisfy the BE ownership provisions, but furthermore are seen as an important policy tool for broad-based empowerment, and in his words, the Minister's words, can contribute to the improved industrial relations in South Africa, making empowerment more sustainable. It was actually this statement that I found most fascinating. The question that jumped to my mind, and has been a fascination ever since the first employee structure that I implemented back in 2007 when the codes were first enacted, was this: does employee ownership result in better performing companies? And if so, to what extent, and how do employees actually benefit? Minister Patel mentioned that there are currently some 50 companies in South Africa that have implemented some form of employee ownership structure that benefits some 230,000 employees. And that sounds really impressive. 230,000 employees, however, represents just 1.5% of South Africa's 15 million workers. This statistic also ignores all the private companies whose data is not in the public domain, and really where some of the, let's call it, less desirable practices that were targeted by the BE Commissioner takes place. I certainly don't believe we have a complete view of the employee ownership situation in South Africa right now. If we were to look abroad to more mature markets like the UK, where over 2 million workers, about 7% of their workforce, and in the USA, where it estimates at around 1 out of 12 employees, or 8.3% of the workforce, participate in employee share or ownership or stock ownership plans. This is more than 5 times the participation of employees in South Africa. The USA is also a much richer data set regarding the performance of employee-owned companies. And in over 100 studies with some 56,000 companies, it has shown that companies with ESOPs significantly outperform companies that do not offer employee stock ownership. Some of the areas where superior performance is stated is in areas like productivity, being 4 or 5% more effective in employee-owned companies, higher sales growth, higher sales per employee. And the most important one, I think, in a recent study was that they found that the negative impact of the pandemic on businesses where employees were part of the ownership of the company is significantly lower. In fact, employee-owned companies were generally more optimistic about their survival and return to normal than others. And in looking at the bankruptcy notice, they found that employee-owned companies were less than half as likely to go under compared with non-employee-owned companies. It seems that this resilience of companies is linked in part to the perceived stability that employees feel when being part of the ownership of the company in which they work. So with all this apparent evidence of the better performance of employee-owned companies in other countries, why are South African employees 5 times less represented in the ownership of companies where they work? Is this just a factor of economic exclusion policies that the BE has been trying to address, or something else? In fairness, the US has experimented with employee ownership since the 1920s, but in reality, the real momentum for employee ownership only happened in the 1980s when tax legislation made it possible for employees to acquire stock in pre-tax funded structures. In South Africa, the first notable employee participation structure of any substance really occurred in 1987, when Anglo and De Beers implemented a 4% participation of workers in their companies, claiming that over 114,000 employees benefited from the scheme. Depending on your view, some have criticized the scheme as only a tool used by Anglo for its political expedience, and not that it was genuinely intended to benefit workers. But be that as it may, 34 years later, and we've only just concluded the debate on whether ESOPs are in fact ownership, and whether black employees participating in such ownership structures pass on the BE recognition benefits to their companies. This may explain the reticence of many businesses to implement such structures. However, credit must go to those companies that have implemented ESOPs, and in particular, Mr. Patel gave special mention to Coca-Cola, who's just launched its employee ownership structure, which includes board participation for employee representatives. Now that's quite unprecedented. Still, the lessons from the USA and other countries are available to us to learn from, and we can maybe leapfrog the implementation of effective ESOPs in this country. It is clear that there are very particular circumstances in South Africa that may negatively impact the perceived benefits of employee ownership. You know, everyone intrinsically believes that if you have a stake in something, that you're actually likely to feel connected to it and more interested in its success. And this certainly appears to be true for ESOPs in companies that are abroad. But the claims that employee-owned companies outperform their non-employee-owned peers seems to be a common claim that is well accepted, especially when employee engagement, productivity, sales, and subsequent company performance is measured. The caveat, however, is that it appears to be only true in those companies where real participation of employees takes place, specifically the inclusion, or at the very least meaningful input into decision-making in those companies by employees. In studies monitored and reported by the National Center of Employee Ownership, the NCEO in the USA, it noted that there's actually a positive correlation between the growth and performance where companies were participatively managed by employees and the growth rates. In fact, the growth rates increased the more participative employees were in the management of the companies. In South Africa, a number of dynamics exist which may undermine the extent to which ESOPs positively affect the growth and success of their companies. The first such issue is that ESOPs have become synonymous with black economic empowerment and black ownership recognition on the BE scorecards of companies. This implies that most ESOPs are limited to participation by black employees. There are even instances in which black employees are further segregated into gender and age classification, where black women and black youth are more favorable than black men in these structures. Understanding our economic past does explain how these dynamics enter into the construction of South African ESOPs. The extreme economic exclusion of black women has necessitated a particular focus on this defined class of persons, which is very effectively done in the additional points awarded for black women on the ownership scorecard for BEE purposes. The question is whether this selection of a defined class within the employee pool results in the same cohesiveness and employee stability that US companies report in their ESOPs, which seems to be a key factor in the company's resilience in the face of tough trading conditions. So the first challenge in South African ESOPs is that they distinguish between classes of employees, which may in fact undermine the cohesiveness and therefore the potential positive results enjoyed by South African companies compared with, say, other well-functioning ESOPs in other countries. But another factor that has a significant impact on the effectiveness of ESOPs is the supporting legislation to enable the affordability of ESOPs both to the companies that sell equity to these schemes and the employees who become beneficiaries. So in South Africa, the tax legislation and the BE legislation, particularly the BE legislation, make implementation quite tricky. Specifically around ESOPs, the tax legislation has actually broadened the net to include much of the proceeds that employees receive from their participation as ordinary taxable income. Now, this is a bit counterintuitive because it means that the proceeds get taxed at the marginal tax rates for those individuals. So while there are certain exemptions in terms of Section 8 of the Income Tax Act, there's still, I believe, a lot of work that needs to be done to support the affordability of ESOPs and the benefits of participation, which Minister Patel alludes to, in fact, in a recent press briefing where he stated that government would work with unions and corporates to improve funding arrangements to ensure that ESOPs provide for real ownership and a greater say in decision making. I think this is welcome news, and it is hoped that the South African tax regime will be brought alongside to support the affordability of ESOPs. There are, of course, some very positive dimensions to employee ownership that are contained in the BE legislation, specifically for ESOPs. Now, firstly, we understand that in line with the general provisions for ownership in the BEE codes, the rights of shareholders are encapsulated in three key measures: voting rights, economic interest, and net value. Now, the BE codes go further when addressing the rights of participants in ESOPs by introducing requirements that entrench participation of employees in these schemes, specifically that employees must take part in appointing at least 50% of the fiduciaries or trustees, and they must have access to all the information, the financial statements, and be invited to the AGMs of these schemes. Now, these measures are aimed at ensuring inclusivity of employees in managing the schemes. However, this doesn't necessarily extend to the role of the employees in the company boards. Now, again, Minister Patel has alluded to the fact that in the company's amendment bill is being prepared that sets out modalities for improved representation of worker interests in company decision-making, and boards in particular. And he's calling upon tertiary institutions to educate workers to become potential directors. Now, in the context of company performance, where increased participation is correlated with improved results across various metrics, I think this is a really good thing. In a sense, this is one of the areas where the BE Commissioner took a firm stance when she attempted to enforce the view that if employees, through their trustees, did not participate in board decisions of the company, then the structure was effectively a fronting structure. This view obviously was overturned in the practice note published on the 18th of May, when it was made clear that fiduciaries, the trustees, are actually appointed to act on behalf of employees, and that this appointment is sufficient to mean that it demonstrates effective voting rights in ESOPs. Sadly, however, I've seen very few effective mechanisms to engage employees in conversations about their ideas or concerns so that they can be heard and acted upon in the boardrooms where decisions are made. This means that worker rights remain primarily at union and shop steward level, and there still exists tension between unions and companies. It's actually quite interesting that, and I think it's anecdotal, that the growth of ESOPs in the USA coincided with the commensurate decline of representation of workers in unions. So while correlation is not causation, it might be interesting to consider whether there's union resistance to this notion of direct employee ownership in South Africa, if it is seen as a way of company owners trying to get employees on sides versus employee ownership via trade union structures, which could be seen as a mechanism whereby union representatives get a seat at boardroom tables. These are some of the interesting dynamics at play around employee ownership in South Africa. The mechanism to implement ESOPs effectively in South Africa is also affected by the requirements of BEE. As we know, BEE awards points for voting rights, economic interest, and net value. So while voting rights are typically captured in the requirements of the MOI, for instance, and economic interest speaks mainly to the right to receive dividends or distributions of the scheme, the more complex issue relates to net value, which speaks to the capital appreciation of the value of shares held by the scheme and how this value flows through to beneficiaries. Now, the recent practice note seems to go, in my mind, too far in suggesting that if a scheme has no sunset clause, then there is no cause to determine and therefore pay out the net value of a share's worth to beneficiaries when they leave the employ of a company. I believe this to be a fundamental flaw that could actually undermine the effectiveness of ESOPs in South Africa to bring about real wealth creation for employees. Evidence in the US shows that employees who obtain a vested right in the shares of the ESOP typically retire with double the retirement wealth compared with non-participating employees. Now, this is achieved when employees leave or retire from the company and the company buys back the shares from the employee. In the South African practice note, it suggests that evergreen schemes can afford companies all the black ownership points they need, even though the employees merely only have what is commonly referred to as a spes or a hope to participate in the income and capital proceeds of the ESOP. In my mind, this undermines the net value objective of ownership, which accounts for about 8 points on the BE scorecard. I think in practice, it's quite simple to allow for net value to accrue to employees, even in evergreen structures. If one creates a mechanism to measure and pay out the net value, The famous examples are Kumba Iron Ore and Exxaro, for instance, that paid out over 3.6 billion rand to employees in 2011, which demonstrates that net value can and should be paid to employees. This can easily be done by unitizing the shares held by the ESOP and allowing employees to qualify to hold units instead of the actual shares. Treating these units as if they were tradable in the hands of employees is a simple and effective way for employees to enjoy not only the hope of an income, but the hope of capital appreciation and therefore wealth creation by virtue of being a holder of a unit that has value, which when they leave or retire is purchased back from the employee. So the practice note issued on the 18th of May at last puts this debate to bed as to the recognition of ESOPs as legitimate broad-based black ownership schemes. And I believe this will see a rise in the implementation of ESOPs. However, unless the tax regime becomes more supportive, unless proper mechanisms exist to engage workers, and unless, and I think the big one, ESOPs do offer workers the ability to generate capital wealth, it may be quite some time before South African companies can also claim that employee share ownership delivers better performance and greater resilience for the company. So I look forward to seeing many more ESOPs taking up ownership in companies, and hopefully we can learn from other countries and implement best practices that support meaningful economic inclusion for workers. Thank you.